Hello, Jason Bates here, owner of Electrum Financial, a mortgage broker located right here in Cave Creek, Arizona, where a mortgage is not just a flip of the coin. So if you're looking to purchase or need to refinance, I would like to be your broker of choice, as I have access to the lowest rates at the lowest cost in Arizona. And if you don't believe me, call me. Rising rates have been on the menu for months, but the drama kicked into higher gear last week. Maybe you heard about this. I've certainly been discussing it in recent weeks. The rising rate narrative hit the mainstream last week as it was widely credited for doing damage to the stock market. Freddie Mac reported a jump in 30-year fixed rates from 2.81 to 2.97, their biggest in nearly a year. Unfortunately, Freddie was low last week and they're way low this week. This is a common problem when things are this volatile. Although their survey is published on Thursdays, most of the responses are in by Monday. As such, their numbers didn't capture the brutal spikes that came later in the week. How brutal can a spike really be if we're still talking about rates in the low threes? That's entirely a matter of perspective. If you decide to float your rate back at 2.75, figuring that rates only got even to get lower, you might be out of luck. So why is all this happening? And more importantly, is it going to keep happening? First off, two separate things are happening. On the one hand, we have a well-known, well-understood, and well-explained rising rate trend that's been intact for months. If you watched my last video or spoken to me lately, you probably would have heard me go into more detail about this. In a nutshell, if COVID caused a rapid surge in persistence and all-time low rates, the improving outlook had the opposite effect, albeit a gradual one at first. The other thing that's happening is a recent acceleration in the long-standing trend, first in 2021, but then even to a greater degree over the past 2 weeks. Plummeting case counts played a big logical role here, as well as the Georgia Senate election and progress on fiscal stimulus. Stimulus hurts rates by increasing the supply of treasuries, and higher supply means higher rates, all other things being equal. There was a fresh reminder about treasury market supply at center stage for this last week's rout. The 7-year Treasury auction last Thursday was the worst of its kind since it debuted in 2009. A bad auction speaks to the absence of demand, which has a similar effect on rates as an abundance of supply. Bonds hit their weakest levels of the week, month, year immediately after that, but thankfully have appeared to stabilize somewhat since then. The Treasury auction definitely wasn't the only consideration last week. After all, the volatility had already kicked into higher gear the previous week. There aren't any satisfying specifics though. It's a combo deal that all speaks to the improved outlook for COVID and the post-COVID economy. There are also some highly technical trading motivations for bond investors that have to do with the changes in the rate landscape. These can force money managers to make big adjustments to their holdings, and those adjustments often play out in these sort of softball selling episodes when traders have the same collective realizations. Mortgage rates have increasingly been forced to pay attention to broader bond market volatility. Last week was the best or worst example yet. The cushion is deflated, and the mortgage market is no longer invincible. Reasons aside, the big question is whether the drama continues or the bounce back is just the beginning of a deeper recovery. While there's never any way to know for sure, what I do know is that our odds of a recovery improve as rates move higher. In that sense, the brutality of the past 2 weeks is one of the best indications of potential support. While that doesn't necessarily make a friendly bounce likely, it's more likely than it was after last week's big rate spike. Optimism aside though, keep in mind that this is a rising rate environment in general, and I don't currently have a reason to believe that trend is at risk of dying. What I'd be hoping for here is a return to a more stable uptrend in rates. That return could help rates move a bit lower in the short term, which we've seen here recently, before resuming their gradual upward trend. Ultimately, it will be up to the course of the pandemic, the economy, fiscal spending, Fed policy, inflation, and other macroeconomic factors to determine the rates through the end of the year. This week brings important updates as far as economic data is concerned. There will be several reasonably important reports throughout the week, culminating in Friday's all-important jobs report. So there you have it. Let me know your thoughts and if you would like more of these videos. Thanks for watching, and if you're looking to refinance or purchase a home in Arizona, I would like to be your broker of choice. Until next time, take care and stay safe.